Tell me something. Tell me something. Is this considered early? I'm going live essentially 30 seconds early on being 30 minutes late. How does that work? Hopefully everyone is doing well. Yes, we are live. We're a little late, but it was all for good reason. So hopefully everyone's doing well. Let's talk some SoFi. Let's talk some other things. JP Morgan earnings coming up very, very soon. The year is going to start flying by. So we're already into January. January 15th, we got JP Morgan earnings. This is when the earnings season is going to begin. Remember, once that starts hitting off, we're going to see a lot of the big banks, Lending Club hopefully soon, SoFi on the early innings of earnings season. Feels like it was just yesterday, but now it's starting all back up again. Get ready. The early parts of the season is whenever banking and fintech and all those names really start to pop out first. So we are going to be up first for this channel. But hopefully this season, we're actually going to rotate into some actual earnings seasons or into some tech names. Love the room updates. Yeah, no, it's getting there. I still got to do this portion over here. So it'll continue along, but it's really helping the acoustics of the room. Making it sound a little bit better. So, yeah. Hey. Liking the room. It's so funny that it was partially up yesterday, but no one said a thing. But it'll wrap. It'll finish. I'm not too quick with it. So we got to work on it. Yeah, it is a soundboard. It is. It's mainly for the echo rather than being loud for the rest of the people in the house. It's just so then everything's for you guys. It's just so then I don't, get any reverb or anything like this. Kay says, hi, everyone. Hello. Okay. Yeah, let's talk about it. SoFi is down, okay, on a report from KBW, Timothy Switzer, once again, the person who has been the most negative on the company and by far the most wrong, can have this type of impact on the stock. It just blows me away. It actually doesn't make any sense. So this, let's call them a cult. You know what? For the most part, even whenever people have differentiating opinions than me, I'll respect them. I'll personally think that they're wrong, but everyone's, allowed to have their own opinions. Perfectly fine. Okay. KBW, little different. So they are presented with the same information that we are. They have been proven wrong over and over and over. And then they go as far as creating their own, sort of key performance indicators that are completely false and misleading to back up their point. It's crazy. So not only what I'm actually alluding to here, because I went through their entire 6-page report. What I'm alluding to here is the fact that not only does SoFi show off their capital ratios, which are a GAAP metric. Okay, this is like not something that they can toy with. This is generally generally accepted accounting principle. And yet they came up with their own adjusted capital ratio that KBW does to make SoFi's numbers look even worse. It doesn't make any sense. Their EPS targets for 2026 are bottomed out. Now, they've been wrong countless times during some of the hardest moments that SoFi has ever gone through. Student loans being ripped away, their mortgage partner being ripped away, highest rate hike in history in terms of the momentum to get to where they were, not the actual highest interest rate, but the highest rate of change in interest rates. All of this is just not necessarily enough for them to say, oh, even though we have new, better macro than they potentially anticipated whenever they wrote their 2026 guidance. We have to remember this. Whenever they wrote the 2026 expected EPS of 55 to 80 cents. So that was in Q4 of 2023, I think it was. Yeah, Q4 of 2023. Trump wasn't elected. There was no rate cuts or anything along those lines expecting to go into 2024 with 100 basis points. Even until late of 2024, Anthony Noto was hard on the idea of 3 interest rate cuts or 75 basis points, not 100. So things have turned out much better for SoFi over the last little bit, which resonated in the stock, showing that the stock went from $7 to $16+ a share. And then KBW comes out every single time and bashes through their EPS and says things like fair value is the reason why things are going to get worse. The fair value accounting was a joke and was like in terms of them picking at it. The actual accounting is not a joke, but this is the sort of piece that retail needs to pay attention to, and this is how they're going to collapse. Didn't work out whenever the macro is bad. Now you think it's going to work out negatively and not in their favor whenever the macro is good? Yeah, right. I think that that's a crazy way to look into this company. So that's exactly what happened. KBW reran the numbers. I think it was at here, let me see. I think it was an $8 price target. $8 price target. At the time, whenever they wrote it, it was $15.63. They are one of the lowest players on Wall Street, and it even goes to show whenever you look at their EPS targets as well. They have some of the lowest EPS targets. And so this brought the company down by 8.25% to $14.13. So whenever we look at this, I can't show a lot of this report, unfortunately. Where can I show off? What can I show off? I'll just show off this piece really quickly. Just this table here. So one, KBW estimates, which is right here. They have all their numbers versus what they are expecting for SoFi's 2026, which is not actually something that they really spoke about. There are a couple numbers that they're using for SoFi, like the EBITDA margin of 30% and GAAP net income margin of 20%, which even then, some of their metrics on margins for, 2024 for financial services, they said that they were going to get it to a certain level. They actually surpassed that. So I believe that they'll even do potentially better than what they said. They did say that they want to throw 20% to the bottom line. Now, look, 2026 expected for Wall Street is 46 cents. It's lower than the bottom end of management's EPS. We've been harping on this for some time. KBW's is 36 cents. Whenever I say there's a real possibility that SoFi hits 36 cents of EPS in 2025, I mean it. Now, it'll be a far stretch, but look at what just happened with Robinhood. I mean, if things align and the market is in their favor, it will have a positive reaction to the upside. Those positive reactions can happen to SoFi as well. They could see some phenomenal gains. Now, 55 to 80 cents, this is what I'm talking about in terms of they are most likely very conservative, SoFi meaning, in this estimate as well. 55 to 80 cents was, like I said, not pricing in what they believe was a good macro, any growth from 2024 that they weren't expecting, any new products. They said, this is what we expect to hit if we do no new products. And they say, no, you know what? They're going to do half of what they say. Tim, that has not worked out for you, brother. That has not worked. Okay? You've come out and said this for years now, and you've been proven wrong every single quarter. All right? And they say, oh, well, SoFi is just pushing out, their problems. This is actually going to amount to something bigger later down the line. And some analysts have been ballsy enough to say, like, what's the other one? Oh my gosh. Someone will say it. He goes by G. He's been ballsy enough to say that the defaults of like Q3 of 2024 will be a certain level. He's been as particular saying, hey, when they record very shortly, Baloney. Giuliano Baloney. That's what I meant. He goes by G. Giuliano Baloney. So he said by Q3 of 2024, their defaults on their personal loans will surpass between 6.7 to 7.2%. That didn't happen at all. It was like 3 point something percent. And then whenever you account for them selling off their late stage delinquent loans, it was somewhere closer to 5.4%. 5.4% is nowhere near your 6.8 to 7.2% expectations. And so they start to create these crazy metrics like adjusted capital ratios that just make it look like things are more worse than they are. Okay. There's this old sort of adage where they say, hey, it's not what the data will tell us. It's, hey, we have this data. What would you like it to tell you? Okay. And so they're nitpicking every single number to see, look how bad this is. Look at, if we align all of these statistics and don't show you anything else, look how this would be an $8 stock. Yeah, of course, all day long. Okay. But you are missing the rest of the big picture, all the things that are going right, all the loan sales that are going on, everything, the loan platform. Why don't you talk about the loan platform business? All the things that are going right that they just completely discount. They're going, look at the 10 things that are not as optimal as the rest of their business. This is clearly a short position. Okay. This is the same thing as Chiavarini, oh, well, our lending club long position and our SoFi short position, this was a really great trade because lending club did better than SoFi year to date. Okay. Both of them went up triple digits. So if you were to have just invested in both, you would have done exceptionally well. But if you were to have actually shorted SoFi and went long lending club, you're actually down a significant portion of money than if you were to have just bought one and not have shorted the other. So they're defending these positions when just historically they've just been wrong. Sad, it happens. Leather jacket, yeah. No, I'm engaged now. I'm engaged. This is my AI support. I wear this to, make sure that Jensen does well. It's like a unwashed jersey for the team that you want to win. This is my Jensen team jacket. Tanner, help us understand why upgrades never cause the price to jump. Ever downgrades always tank it. It's getting old. Well, I think one of the real reasons is that the upgrades don't get any coverage at all. If I think DDI had covered this, and I don't think it's as malicious as what he thinks. He thinks that I don't want to put words in his mouth, but I remember it being somewhere along the lines of a little bit manipulative, where, in my opinion, it's just, these news or these blog and article companies just simply knowing that the bad news sort of sells, and the consensus reports of some stock actually getting re-rated positively, they just simply want no part in it. Unless it is a drastic call out, like the call is going to triple the stock or something along these lines. Those will get traction as well. But anything negative is going to pick up more steam because it's counter to what has actually happened. It's sort of quote unquote ballsy for Timothy Switzer to come out and say, hey, you know what? This stock is actually going to fall after it's done a triple digit run up. Well, yeah, I mean, you are actually being contrarian, but I'm also going to go on the opposite side and say, hey, it's not only is it contrarian, it's also wrong. He could be right, but I just don't think so. Yeah. So it was just, all of this stuff was just a little bit silly. A little bit silly. The part of this in their adjusted capital ratio thing was the idea that there could potentially be more capital raises from SoFi. They specifically said that they're not going to be doing more capital raises, that they feel really strong at the levels that they're at, and that there was a large amount of, or a lot less amount of book sales as they wanted to sort of raise their book value to a certain degree, have this nice loan portfolio, but now they feel like they've really achieved that, and they really want to go after a lot of these loan platform tools. So this is why I think that the loan platform business for personal loans is going to do well, but also, and probably mainly, student loans as well, because we may not want to hold them on our books, but it could be a good way for asset managers or other banks to diversify their portfolio. So who knows? But I think the adage of over the last year or so of calling this a bank is just further every single quarter going to look more and more like a silly prediction. And unlike what we were seeing before, where the stock was at $7 and then ran into the high teens, is that people aren't just like, they just simply were not believing what analysts had to say. And I think that this is just one of those last fears. We sort of talk about this a lot, where you see companies like, let's even call out Robinhood, for example. Robinhood shouts out every single win that they have, okay? And I love them for that. But whenever it actually comes to their earnings results, if you guys remember from last quarter, they missed by 1 cent on EPS due to a regulatory accrual. Okay, so the only reason why they missed was a simple legal expense that they ended up having, right? Where the rest of the quarter was an absolute slam dunk. The stock fell on that news. But the entire 3-month quarter, it was nothing but positive action and people getting more and more excited about the report. SoFi, I feel like it's the complete opposite. It's nothing but great quarter, and then just throughout the next 3 months, people get pessimistic as they go, oh, what is SoFi going to do? They're not innovating. They're not telling us what they're doing. And then boom, the quarter releases. It's so much higher than any of our expectations. They have been working on a lot of products, especially on institutional or underwriting or stuff that we just aren't able to see. And then boom, stock rises once again on new earnings, which is actually based on real fundamental results. That's actually more important than good news, right? Good news can fluctuate a company's perspective. Like, I'm sorry, I don't want to say this too loudly, but I think that Palantir runs off a lot of news and a lot less on the actual fundamentals. Okay. You're looking at a PEG ratio on that company of about 10. I'm looking for companies with PEG ratios less than 1. So, like, I don't know. So, anyway, there's these companies that can do very well on news, and then there's companies which, in my opinion, you want to hold, which perform really well on actual fundamental results. They can be a little less slow, a little bit more, harder to hold over those 3 months, but then you are actually rewarded over those periods of time. So, in my opinion, SoFi will continue to execute. They are above the expected amount of new members that they were supposed to do. It might be a record-breaking new member quarter, okay? Over 10 million, not new members, but 10 million members total. We got that update already. So why are there, how come all these new members are coming onto the platform? Is this a new marketing effort? Or are they going out and spending more because potentially they have a large amount of loan sales that they're actually sending out the other door, so they're paying for new originations to come through? That is by far the most optimistic outcome. Could be why the members are climbing. And then we also see zero insight into what financial services is doing. Can we get a little insight into those SpaceX shares, or potentially the entire alternative class that they have, the robo advisory, all these other products that they've been working on? Can we hear about how they've been performing? At Robinhood, they've been saying this. They've been doing investor days. SoFi, I believe, one of their biggest blunders is just simply not more transparency and word out to the investor class. But that's the only problem. If that's the problem, and then each and every quarter they continue to release good results, then hell to these reports that tell us that this is an $8 stock. Okay, I don't care about your adjusted capital ratios, which are based on your assumptions and not based off the actual true factual numbers that are audited, by the way. Like Not only is SoFi's fair value based on their numbers that they've been collecting for 10 plus years to understand their user base, but also the fact that they get in third-party auditors to go through the books and also double check the results to make sure that there is no biased result here. Okay? No. That's perfectly fine. Let's trust KBW. What is their incentive? So to me, it's just absolutely silly. That being said, we can't control what other people say about our company. It's not like the first time that Meta during its run up has, gotten negative press, or Google, or really any company. All of them see this. It's just, how does the company actually execute to push those to the back burner? And right now, it can seem, just because of the way that SoFi is currently angled, that potentially they are more expensive than their peers, but versus their banking peers, I should say, not their fintech peers. But we need to start being looked at as more of a tech, more of a fintech, more of a fast-moving, fastly innovative company. And that just has to do with SoFi's ability to disclose that and close deals on Galileo's side. But just imagine that, right? Think about the way that Palantir changed their, valuation from before AIP boot camps to after, right? They essentially unlocked a new way to acquire new customer bases. And they said, hey, this is actually really effective. And we didn't try this before. So we've always had good tech, but we never had a good sales team. We've changed that. We actually have a really good sales strategy. So people are actually showing up and buying our product. Okay, perfect. Upgrades. How does SoFi go about to say, hey, you know what? Maybe we create something like the Upstart macro index. I can show you guys that, where it just simply allows people to track the performance of their company on a monthly basis without actually giving away any results. This is a perfect way to just give transparency to the user base. I can show you this, which, by the way, affects SoFi on a one-to-one basis. Okay, look at this. Upstart's macro index. A massive climb in this macro index is really, really bad. We want to be at 1 or below. Okay, that's whenever their loans perform at the absolute best. It's when the company is doing their best. So if you follow this company from November of 2021 all the way up to the peak at, let's say, May of 2024, the stock's not looking good. Okay, I can pull that up in a second. I'll show you that here in a sec. But then over this last little bit, as this macro index has fallen, the stock has skyrocketed. Why? Because it's a simple one chart a thing that shows, hey, you know what? We're actually performing well, and we're able to sell more stock because our loans are performing better than expected. If SoFi came out with the SoFi macro index, that could potentially just blow away the Timothy Switzers of the world and say, hey, we are not seeing this, as long as it's backed up by actual performance. But SoFi's never lied. I don't expect they're going to start lying. And if there was any, quarter that's going to come out and do poorly or something like this, I'd sure hope that they'd come out and say something about it. So let's go. What was that macro index? Sorry. Between May, June, and then starting in August. Okay. May, June, and starting in August. Let's go here real quick. This is Upstart stock. So starting from May and June, and then really kicking off in August, you can really see how this is where the stock started to climb. And then the macro index continued to fall, and the stock just skyrocketed. Okay. This drop a little bit over here is actually probably the flatlining of their Upstart macro index as well. So it's not a perfect metric, but it does actually correlate very well with how people should suspect the company to do over time, right? If the loans are under 1 times, Upstart should be overperforming or an outperform. Other way around, not so good. So, yeah. But aside from that, there was one other piece of news that I really wanted to cover for you guys, which was, I could do this on a more Robinhood based thing. So what we ended up seeing, we saw the Robinhood numbers come out the other day. By the way, they were stunning. If you guys aren't interested in Robinhood, start getting interested in Robinhood. They are exploding right now on their overall activity that they're seeing on the platform. This is why Robinhood ran today and other companies didn't as much. But yeah, like for example, Robinhood's up 6%, trying to break through the $40 mark. And then on top of that, you also see other companies like IBKR coming out and saying, hey, you know what? We also did very well on our side as well. Well, people always forget, people really downplay SoFi and how well they do. It's like they have a SoFi Invest platform. You know, we will benefit from uh, user activity on the platform. Why won't we potentially go up on this news if financial services outperforms? And not to mention financial services this quarter is going to include the loan platform, SoFi Invest, SoFi Checkings, which is still going to be booming because interest rates are still quite high, although dropping, still very high. It is, as Beek says, a long-term hold. Yeah, I mean, if it depends on your outlook of the stock. That for like my peg ratio on this company is still way under one, especially after today. So, like, I don't know if you do believe in their 2026 outlook of being as conservative as 67 cents. Okay, even if you're above 46 cents, you are beating Wall Street. That is below their bear case, somewhere that SoFi has never landed in the history of their company. Okay. Every single quarter that they've put out, they've beaten expectations. So, one thing that I'm going to love coming up in this new quarter is not only are we going to get Q4, which I think will be a blowout quarter, but we're also going to get 2025 guidance, which is really going to close the gap between 2024 and 2026. If we know what their EPS expectations are for 2025, that will close the gap. We will be able to actually see, okay, you know what, they expect 100% growth here, 120% growth there, not what analysts are expecting, which is like an 80% growth here and a 20% growth over there. Like, so that will be very, very good for the company, for Wall Street, really, on their ability to actually look through the numbers. On what term will SoFi give fresh $15 shareholders some bang for their buck? Good financial performance, YG. And how fresh are you? Are you just building out a portfolio here, or did you go all in at that price? Because right now you can literally buy it for cheaper than that price right now. So how fresh are we talking? Because if you have a $15 average and this is a long-term buy, are you looking, like, I don't know your investment style, but I DCA over time. And if it's a small position for me, if it's a larger position for you, you should already have an average way under that because it's been sitting at under $10 for an extremely long period of time. But during these periods, look at that -8 as a real benefit, right? Okay, so someone else just looked through your stock and said, hey, this is $8, but you are doing due diligence on your own and saying, hey, you know what? I actually think that this can run a lot further. So why do you feel like you're missing something? Is there something in these KBW reports or other bearish reports where you go, oh, you know what? I missed that? Or is it the fear of the unknown? Because if it's the fear of unknown, you got to do more due diligence. It's down 18% from its 52-week high. Show what? And no, that's not true. Oh, sorry, 52-week high. Yeah, that's probably true. I was thinking all-time high. I was like, that's not even close. Yeah, who cares? Today is the perfect example for why it's so important to know what you own. Exactly. Amit said he's considering buying more SoFi. Dude, the guy put a freaking, what was it? $9 end of 2024 price target on this company. I'm not having it. B-Dub said it a long time ago. He said Q3 will be the most important quarter and Q4 will be also exceptional as well. I might be butchering your exact quote, but it was something along those lines. Like Q1 and 2 were not as important as these back half quarters. We're now here. Okay. We saw Q3. It was outstanding. Everyone in the SoFi weekly audience or like crew, we do a weekly show. We all had very bullish, outgoing expectations for SoFi. And they literally beat every single one of us. On EPS, on members, no one guessed higher than what they actually did. It was ridiculous. That doesn't happen. Everyone looks at the way that we look at SoFi and they go, oh, they are too bullish. No, it's just they keep outperforming us every single quarter. Okay? I say one thing, they do another. They literally created a product that is going to have potentially $6 billion of a run rate for 2025. They said, Anthony Noto said north of that, north of $6 billion in the loan platform business for origination sold, okay, for 2025. They created that product a couple months ago. How many companies can do that where they come out of nowhere and it's one of their largest products they've ever released and they did it like that? Yes, B-Dubs is 100% true. The loan platform was the game changer. It's literally what allows us to be considered a bank, to be considered, oh, well, you know what? If Upstart is allowed this valuation, why isn't SoFi? Because we have no capital ratio constraints anymore, unlike what Timothy Switzer says. That doesn't constrain us. The only reason why tangible book value would even play a part in valuing a company is if it limited their total amount of earnings. Banks are limited by their earnings because they can only grow their book as high as their leverage that they have on their capital ratio. So if they're told to hold $100, they can only go out and give out 1,000. Okay? Sounds crazy, but they can essentially 10x leverage. But SoFi can have $100 and give out 10,000, 100,000, $1 million if they want. That's what allows Upstart to get valued so high, is that if they do have an underwriting standard that is better than others, okay, you can put buzzword AI, machine learning algorithms, everything along these lines, but it's barely outperforming in certain categories better than FICO. So I don't care about that at all, or else every single bank under the sun would pay for Upstart's personal loans. They don't. For some reason, they also come to SoFi and buy a heckload of loans from us as well. Actually, right around the exact amount that Upstart made last quarter. And yet we just did it, and it was our first quarter ever in that industry. Why? Because take away the word AI, take away the word machine learning. Essentially what it is better underwriting standards. And are you going to get a better product at that for the price that you paid? Okay. If SoFi can do that, then you don't think that they're using AI, machine learning, different metrics that are actually cash flow related rather than income and FICO related. They use sort of a system that actually goes off of, hey, what's this person's intake and what's their outflows for their bills and expenses and everything like this? What's left over? Can we actually afford to give them this loan? Are they going to pay it back due to previous behavior? So, and then on top of that, Upstart, even though they're getting this crazy valuation, once they go and sell that loan to that person, the only way that they get a reoccurring purchase from that user that they just paid for, they have to go back to that user and say, hey, want another loan? Would you like another loan? That's not good behavior. So what does SoFi do differently? They say, here's the loan that you asked for. Do you want a checking account? Do you want a credit card? Do you want debt monitoring services? Do you want robo-advisory? Do you want a real advisor over the phone for free? So although a potential new bank or asset manager just paid for the user to potentially buy their loan and use SoFi's underwriting standard that is superior, they didn't pay for or have any part in the other products that they get with SoFi because it truly is a one-stop solution. Okay? That cross-sell is absolutely free for SoFi, and it allows them to price better than any other player in the business because they can price that into their pricing, right? But Upstart can't. They can't go, oh, well, you know what? We can actually charge a little bit less here because we're going to make it back on all these, external products that this person is also going to get with us. Nope. Nope, they're just going to ask you for another loan. Okay. And they tote that. They say, oh, well, our user base, 33% come back for a second loan. You don't think that's going to happen at SoFi? You don't think the person that gets a personal loan, if you guys watched the recent Robinhood Weekly episode, although it was a Robinhood Weekly, there was a segment where we were talking about SoFi and the Robinhood Bull that we had, the guest that was on, Joshua, he said, well, actually, I just took out a SoFi personal loan. We were doing some home improvements and I applied for it. They approved me same day, and then I got the money the next day. He said it was absolutely instant and seamless. So how come this super Robinhood bull is getting very bullish also on the experience, the customer experience that he had with SoFi? Because that's where their experience lies. And everyone forgets that. They all go, oh, well, you know what? SoFi Invest is not as good as, Robinhood or something like this from a user experience perspective. But what about the loans? What if you just compare it to lending clubs of the world and the upstarts of the world? We dominate that area. And there's a heck of a lot more money there than there is on the SoFi Invest side. So, we always do this whenever investing is we look at companies like Google or Amazon and we go, oh, well, these segments of the business are taking off. And I do this as well, right? Where I'll look at Google and I'll go, quantum could be a big thing, and Waymo and Wing and all of these little things. And then you start to look at the actual revenue breakdowns of those segments, even the large ones. Like look at YouTube as a perspective of their overall revenue. It's like a sliver of the company. I think it's less, or it might be 11%. YouTube is 11%. And everyone forgets about the more than 50% chunk, which is Google search. In SoFi's perspective, that is lending. Everyone talks about, including me, all of these extra products when really there is still just a giant that is lending, where that's the macro that's improving. Lending right now has the best environment that it has to grow than what Anthony Noto said was better than the last 7 years. So what's going to lead this stock to grow? Is it going to be robo-advisory triples and then it goes from 0.1% to 0.3% of our total earnings? Or is it going to be the thing that's 53% of our total earnings that could potentially blossom into much more than that, which also has the highest margins in the company? The only product that actually has higher margins is the loan platform business, which is looked at as financial services. That's the thing. Lending is so freaking big that they throw a large portion of their earnings and consider it financial services. It's still lending. Okay. So it's probably even a much larger perspective or a larger percentage that they even break up to make it look like better diversification. Now, it is a little bit of both, but it's still lending. SoFi's an $8 stock all day long. All right. Ally is better than SoFi. Good luck with that. And you know what's the thing? Here's the funny thing. A couple things. One, the loans that they actually are trying to get around auto loans is just a shit environment. They are really predatory. But two, Ally could have been what SoFi is doing. They had the ability to become that one-stop digital bank, and they messed it up. Okay? SoFi could potentially turn into what Ally has become, and slowed growth and not being able to get users, and a loan book that potentially deteriorates due to a bad macro and potentially bad on their side as well. But we haven't seen that at all. And in fact, we've seen the opposite, where every competing business that is around them either dies or has massive failures on their side, when SoFi actually shows off better than expected growth rates each quarter. During the student loan crisis, Discover Financial Services was one of the largest companies in student loans. They had like a $10+ billion student loan portfolio. They sold it off. They said, we can't do this anymore. Common Bond, another big one. They said, hey, you know what? We're packing up. We're going out of business. There was two others that came out and they said, you know what? This isn't the environment for us. This moratorium killed us. We're out. SoFi said, all right, we have 65% of the private student loan business in terms of new originations. We're going to take these learnings and hold on and drag it out into the next environment. Now we're here. Okay. So SoFi stuck it out. And how did they stick it out? They came out with new products. If Anthony Noto is anything, he's a wartime CEO. When things are bad, he does great. They diversify, change their strategy constantly. And it makes them look unstoppable during these moments. Now, all the wind is on their back. How well are they going to do while things are actually going well? And you're going to throw it an $8 price target at me? Get out of here with that. Come on, man. No, thank you. Any thoughts on StoneCo? No. They're like the Block Inc. of LatAm, where they deal with both the merchants and the consumers. I had them before in my portfolio, and then I sold them because I'm like, why am I touching this company? What's the point of the risk whenever I could buy Mercado Libre or Nubank and just have the easiest time sleeping at night, knowing that those companies will go up? Noto is great, but Carp has a better hairstylist. You might be right about that. The $8 price target was a gift to us long-term investors. Yeah, if you're looking to buy more, absolutely. If you're looking to continuously, or if you're DCAing on a weekly or bi-weekly basis or monthly basis, yeah, it could be a great thing to happen. Nothing has fundamentally changed about the company. The company went down 8%. No bad news happened. Okay. It's just some guy came out and said, hey, I don't like it. There's people in the stock saying that Ally is better than SoFi. Like, there's people just in this chat. Are you guys going to sell because that guy said Ally is better than SoFi? That's what you're doing here. And then you have people that go, oh, well, analysts probably know this company better than you, Tanner. And I'm like, dude, I don't think so. Like, I follow this company with like a magnifying glass. Okay. And yeah, I do not see it. I don't see it. I don't believe them. They've been wrong. I've been right. It was a planned attack. I don't know. I don't know. See, here's the thing is like whenever the company does actually fall by 8%, it's like, oh, wow, look at what maybe Tim was right. It's like, no. He has a lot of control over the overall market. It's not market manipulation. Oh, I mean, it's not legally market manipulation. He's saying his opinion. What matters is whenever the quarters actually report and the numbers come out, what happens then? You know, was he right or was he wrong? He's been reporting on this company for years. Okay. Giavrini, Bologna, Timothy Switzer, all of these guys have been reporting on this company for some time, and they've been extraordinarily wrong. Who's been right? Dan Dolev. He seemingly is the only person that doesn't look at this as purely a bank stock, and he actually looks at it as a fintech. You know, 4 is doing well, surprisingly. Shift 4 is doing well. Okay. So, guys, I told you that there was some fun new stuff, and I have some fun new stuff. One, I told you, the course, I said the price was going up. The price has gone up. Use this code to get the old year's pricing. You got 4 days, a little over, well, let's call it 5 days. Okay. Not a lot of time. I also put out a new course. Okay. This is my spreadsheets course. It's a pre-order right now, but it will be coming out later. Now, this is the thing, and all the members currently will get a what do you call it? Email. Okay. Every person that bought the course originally, I'm giving you guys the course for free. every one of you, because you guys supported the course early on, you're all getting it for free. Just email me, and then you can have that. The coupon or whatever, what you see here on the screen, nothing's on the screen. For this is not going to get you a better deal than anyone else has ever gotten. This is only going to get you what the 2024 pricing was, which was $340. Okay. So, yeah, that's just going to get you before, because it's just the way I had to set it up in order to add the new pricing. It didn't let me do strike through prices or anything like that. And the bundle will give you 50% off the new course if you're coming in and buying it right now. The people who are buying today are not going to get the new course for free, but all the people who did, it's absolutely free. Thank you guys. I love you. And there's going to be a lot of new updates. Right now, that one course is just for pre-order. It'll come out January 7th. So on January 7th, I'm adding a lot of new features. So there's going to be a new chapter on the old course. I'm going to be doing weekly course member only live streams on Discord. So you have to join Discord to get that. You get a full portfolio reveal as well as my updates to my portfolio whenever I do big buys or sells, add new positions, sell them, whatever. I'm giving you guys all that. And what did I miss? And the new course is on spreadsheets. So I'm going to be going through that, probably do a separate thing on telling you guys what that's all about. But it's essentially going to allow you like a Lego brick building on how to create spreadsheets. And it's all completely automated well, it's not completely automated. There's some manual stuff, but just allow you to build your own spreadsheets and track data for those stocks. So then you can actually get sort of an in-depth thing that is much cheaper than paying for a Koi Fin or one of these things that are going to essentially data aggregate for you. But even then, they don't get you like non-GAAP metrics, right? So if you want to know how a company breaks down the revenue by geography, or if you want to see, Tesla's solar deployment or any of these sort of things, like you can't really see that on these data aggregators like Yahoo or whatever, because they're only connecting to the SEC.gov. So if it's not GAAP, you don't get it. That's why I use spreadsheets. That's why I allow myself to sort of add all those margins and growth rates and everything like this. So that's what the spreadsheet mastery course is going to be about. And I give you full access to that, a whole bunch of really cool stuff. But yeah. Is SoFi a bank or fintech? SoFi is technically, they are licensed as a bank, but there's a thing called SoFi Bank, and then the parent company is SoFi Technologies. And SoFi Technologies does a lot of things that falls under the financial tech, which is fintech genre. So I would call it a fintech, but they have a license to a bank. Unity. Did you sell Unity? Yes. I'm not a momentum trader. I'm not worried about Roaring Kitten or something. That made me sound so old, dude. I don't know why I said that. I know his name's Roaring Kitty. He didn't deserve that at all. I could have called him Roaring Kitty. I don't care about any of that. Okay. I did the $100. It was $100. I don't care either way. But yeah. Yeah. To the people who are already course members and want access to the new course that comes out January 7th. And by the way, the first live stream is on January 7th after this. So it'll be at like probably 9:30. But yeah, if you want access to that, make sure that you email me. Email already sent. Cool. Cool. Sounds good. All right. That's it. Thank you all so much for watching. Really do appreciate it. During these times of crazy price action, let's calm down. Let's remember that this is just one person's opinion versus yours. Okay? You're doing the due diligence. You're understanding the company better. Tell me what you don't like. Is that worth $8? Are you going to trust someone that's been 100% wrong on the company? Thank you. Bye for now.